Hello, everyone. We hope this video finds you and your family well this summer of 2026. This is our brief and short video on our mid-year outlook for 2026. As you know, this July has marked a historic milestone as the United States has celebrated its 250th anniversary, a testament to our enduring strength, innovation, and economic leadership. As we release our mid-year outlook, here's what we're watching in the second half of this year. First, the economy. The U.S. has been long defined by our resilience, and that strength has been evident today. Despite higher oil prices and geopolitical uncertainty, growth has remained solid, supported by steady consumer spending, go Americans, and a stabilizing labor market, and as you know, strong continued investment in AI. As a result, we expect the economy to remain healthy and grow at roughly 2.4% in 2026. Next up, oil and inflation. This is a key risk, and we've recently seen a surge in oil prices. However, with the US-Iran deal in place, then not in place, we are still optimistic that both countries would like to reach a deal. If this happens, we anticipate supply to recover fairly quickly, and prices could settle down to around $70 per barrel of oil by year end. That shift should help ease inflation, giving the new Fed chair an opportunity to hold rates steady through 2026, although some anticipate a possible rate cut in 2027. In turn, we expect the 10-year Treasury yield to finish roughly about 4.25% to 4.5% year in. Given this environment, we prefer high-quality bonds, which do include U.S. Treasuries, investment-grade corporate bonds, high quality, as well as tax-free or municipal bonds. As you know, we've been very conservative and oftentimes remain a little bit shorter on duration for a good portion of bonds or fixed income. Next up, it's the stock market. Stocks have really started the year strong, driven by better than expected earnings and meaningful revisions to the upside. While technologies continue to lead, we also expect participation to broaden out into other sectors. This would include industrials, consumer discretionary, those things I want, don't need, but I want, right? As well as healthcare. Even with the volatility likely to pick up, and we are entering the midterms, and historically, we do see volatility before the midterms. Our S&P target for year end is roughly 7,600, potentially 8,200 over the next 12 months, pointing further upside. Our preference for the stars and stripes over other developed stock markets has remained in place, particularly because of the strong earnings and the faster earnings growth. The bottom line, much like our nation itself, the fundamentals of the stock market have remained resilient. The backdrop supports a constructive or positive outlook for us investors. Though, as always, we must be vigilant and anticipate some volatility and choppiness. At the end of the day, we're excited to be part of your journey, and thank you for the trust and confidence you've placed in us as we close out the second half of this year. In the meantime, we wish you, your friends and family, the opportunity to have a great summer and make many new memories. And at the end of the day, that's what these resources are about, right? Time with our friends and family and doing what we want. Well, I guess what we need and a little bit what we want, right? Wishing you a great summer. For myself and the team, have a great July.